Well, we've got a poll to get us started and s- allow us to start thinking about the topic for today as we let folks roll in here. Got a whole crew over with Kayleen. Hello, guys. And go ahead, keep working on those poll questions while we give folks like a couple minutes buffer to roll in, get acclimated, get comfortable. Okay. Oh, people are rolling in. Okay. We'll give it like 30 more seconds. If you haven't done the poll yet, go ahead, take a couple minutes, answer those questions. Okay, look at us. Okay, quickly before we get started, make sure your cameras are on so we can see your beautiful faces. If you are a student leader or you're alumni, make sure to throw that in front of your name so that we can identify you, and that makes the breakouts even easier. So go ahead and adjust your names accordingly. Okay. If you guys did not remember from last week and you did not infer from the poll, we are talking about investing today. We're talking about interest. We're talking about compound interest. We're going to cover a lot of topics, which I'm very excited about. So if we look at these poll questions as a jumping off point, earning interest on your interest seems to be the winner in terms of which sounds the most powerful to you. We are going to look at the numbers behind that in class today. So if you read that and you're like, I literally don't even know what that means, then hopefully at the end of today, it will make a little bit more sense. Um, when you hear the word investing, your first reaction. We've got a pretty even split between it sounds risky, it sounds confusing, and that's how people build wealth. So we are going to hopefully tackle some questions so at least it's a little bit less confusing. I'm sure people are all coming into this class with different levels of context and background around investing. So for me today, I want to make sure that we have plenty of space for you guys to ask whatever questions you would like to have answered, and I will answer them to the best of my ability. And then, last but not least, why do people say don't put all your eggs in one basket? Most of us are saying to reduce risk. I think that is that's probably the most important reason. And we'll talk about all of those options as we get through today. So hopefully this gives everybody a little bit of context. And with that, we can share our screen, pull up the slides for today, and get into all of the good stuff. Before we start talking about investments, a quick recap from last week. We can go to the next slide. Okay, so again, reminder, last week we talked about goals and we talked about having a vision and why those things are so important for our mindset and to make sure that when we are in a growth mindset, we're pushing ourselves, we're letting ourselves get a little bit uncomfortable because that uncomfortability, as long as it's an appropriate amount, is what's allowing us to stretch, right? We talked about stretch goals. How do we get a little bit out of our comfort zone so we can keep growing and flexing new muscles and allowing ourselves to change and do things differently over time. So, obviously, it's a very important place for us to start when we're thinking about the semester. But I want us to keep those goals front of mind. So part of what we did last week was in the workbook questions, you guys thought about what do you want to accomplish this year? What do you want to accomplish over the course of the semester? A lot of you guys shared some really good stuff around how you want to show up, especially in this class. And so just remind yourself what those goals were, remind yourself how you want to show up. Um, and hopefully we can make the most out of class today. Okay. With that, we are going to go over the learning objectives really quick. Does anybody want to read this first learning objective? Yeah, Genesis.
Um, Understanding how taxes, interest, and compounding work together to shape personal and national financial systems, and recognize the impact of early investments and factors on long-term growth.
Yes. We'll touch on taxes this week. We're gonna do even more on taxes next week. But definitely interest and compound work is going to be a big topic, as well as investments and all that good stuff. So with that, who wants to read the second bullet point that we have here? Yeah, Antonio.
Distinguishing between saving and investing by examining how risk, return, and inflation affect financial outcomes, and learn to align financial goals with appropriate strategies.
Yes. So we can save, we can invest. Whether understanding when we should be saving, when we should be investing is obviously there's some core principles that we want to cover, but it also depends on what your goals are and what's important to you. So there's not always a 100% right or wrong answer. Again, there's some principles that we'll cover. But a lot of this is understanding what are you trying to get out? What are you trying to create for yourself? And then we can reverse engineer what strategies make the most sense. Okay, who wants to read the final bullet point for us? Yeah, Jessica.
Explore common investment vehicles and learn how diversification reduces risk and supports long-term financial stability and growth.
Yes, we have a lot of options. We're going to cover a decent portion of all of the options that we have in terms of what investment can look like. And again, that idea of like we don't want to put all of our eggs in one basket. We're going to look at all the different baskets that we can put our eggs in. So, how I actually want us to start today is I'm going to put us straight into a breakout room. And what I would love for you guys to chat about in this breakout room before we jump into all of the stuff around investments and um, interest and compound interest and all of our different options. I want you guys to just chat in your small groups and identify what are some questions that you have. To me, I feel like, again, probably a lot of us have very different backgrounds and have very different types of questions around this topic. So I want to make sure that I'm answering the questions that you guys actually have as we go through today. So in your small groups, if you guys can come up with I mean, as many as you want, the sky's the limit, but like two or three questions that are most front of mind for you right now that you would love to have answers to walking out of today. And then when we get back from breakout rooms, I'll capture some of those and make sure that we hit on that as we go through class today. Does that make sense? Cool. Awesome. Okay. So we'll throw into breakouts for like 3 or 4 minutes. Um, yeah, and just chat amongst your group. And maybe the student leader in your group or the alumni person in your group can be the person who's in charge of kind of reporting back to us what questions you guys came up with. Does that work? Okay. Beautiful.
All right, let's open that up. See you guys later.
I might go into room 3 because it doesn't look like the student leader has joined there yet. So just to make sure that they've got someone.
Um,
Oop.
Oop. Yeah, Will's already there, I think. Yeah. I know room 2. Okay. Let me go ahead and assign Amber to room 3 as well. Right.
Beautiful.
Great.
Where did I go?
Shayla, are you supposed to share your PPT to the breakout
Mm.
room? Yeah, it's not
Oh
sharing
yeah.
right now. Yeah,
Sorry. I should suppose. Yeah, actually. Sorry, I was busy reassigning this one. Okay, go. Can you guys see it now?
let me check.
Okay. All
What's
right.
it coming up with?
All good. Just wanted to know what they're supposed to discuss during the breakout rooms, just in case.
They are coming up with any questions that they have around investments, interest, um, kind of all the stuff that we're talking about today. We just want them to come up with a couple of key questions that they would love to have answered over the
Okay.
class. Yeah, of
Thank you so much, Shayla.
course.
All right, they're coming back.
Beautiful.
Wait, let me just. All right.
Hello. Okay. I think we had four breakout rooms. So, does which student leader would like to kick us off? What are some questions that you guys talked about in your breakout rooms? Yeah, Mia.
I'm a question that was made in my breakout room. It was talking about how does investment works.
How does investment work? Love that. Any other questions that came up? Yeah, Dante.
Me and another person in my group were wondering how taxes work. There's taxes there's taxes when you buy stuff at the store, but there's also taxes when you get received money and I don't know
Yep.
other taxes.
Yep, 100%. And we'll touch on that one briefly today, but next week is going to be all about taxes. So, we'll, if I don't go into a ton of detail today, just know that uh that's all next week too. Okay, what about any of the other breakout rooms? What questions did you guys come up with? Yeah, David.
Yeah, so my group came up with two questions, and the first one was how do we know which company to invest in? And the
Mm,
second one was how do I know how much money to invest?
beautiful. Sorry, I'm writing these down. Okay, what else? Where are the other student leaders? Yeah, Amber. Oh, you're on mute.
Sorry.
You good?
We wanted to well, like my breakout room was talking about how investments affect us in the long term. So like in the long
Mm-hmm.
run in life.
Yep. Any other questions from anybody? I feel like there's still one group that maybe we haven't heard from, but I'll also open up the floor to anyone who has a question that hasn't been posed yet. Okay,
I think all of them go. I think.
beautiful.
Yeah. Hmm.
And as new questions come up, as we're going through today, I mean, this is true all the time, but specifically for this class, again, we're going to be throwing a lot of information at you guys. So any questions that you have, feel free to raise your hand at any point and I'll do my best. Cool? Okay, let's jump into it. We want to hop to the next slide. Okay, we're going to start with interest. So, interest is interesting because it's a word that there's kind of two sides of the coin when it comes to interest. Sometimes we have to pay interest and sometimes we get to earn interest. So, interest is basically the amount that you pay when you're borrowing money. It's also the amount that you can earn if you are lending somebody else money. Now, we tend to pay interest if we borrow money from somebody, we have to pay interest on that. So let's just say you took out a business loan, for instance. You'd have to pay back the amount of the money from the bank that you, or from whoever that you, let's say it's $10,000. You have to pay back the $10,000, but then they would also put interest on that and say, you're going to owe an amount of money over time for however long it takes you to pay this back. And they put a percentage on that, right? So that's what would be like the cost of borrowing money. I think probably a more realistic example would be like credit cards. If you put money on a credit card and you don't pay it all back, you then have to pay interest on the money that you borrowed. So that would be an example of when we have to pay interest. When we are using money that is not ours, we're going to pay a little bit extra, or maybe sometimes a lot bit extra. It depends. Credit cards can be a lot. Credit cards can be like 20% interest. Um, Sometimes a little bit, sometimes it's a lot, depending on how much money we're borrowing and how long we're borrowing it for. So that is the That's one half of interest. The other half of interest is when we lend somebody money, we get to make interest. And so how that tends to happen is a lot of times when you put your money in the bank, in a savings account, for instance, you will get an interest on that money because yes, the money is fairly safe. Obviously, it's in the bank. You know that you can rely on it, but the bank is also utilizing that money in the background. And they are making money on your money. And so, in a way, you are giving the bank access to your money, and so you get interest on that. So, there's a lot of, for instance, if you guys have ever heard about like high yield savings accounts or lots of different savings accounts, it'll be like a percentage of interest that you get just for keeping your money in there. So, I think my savings account, I get like 3.3% interest. So if I put money in that account and it just sits there and let's say I put $100 in that account and I don't touch it, at the end of the year, I'll make 3.3% of that money. They'll give it to me in interest, which on $100 might not seem like a lot. But the more money you put into account, that can grow over time. Um, that 3% that I just talked about in that example of like a savings account, that would be the simple interest. The simple interest is literally just what is that small percent that I'm making? It's like whatever the percentage is. So again, the example that I'm using, 3% in just like a normal savings account, right? That's simple interest. So if we look at this example down at the bottom, this is an example where you put in $100 every single month until you're 65 years old. So if you start doing that and you're 14 years old, the amount of money that you will end up putting into that account, $100 at a time for until you're 65, you'll end up putting in $61,200. That's how much money you will contribute to the account in that time. The simple interest is how much are you going to make in in that like three again, I was saying 3%. This example is 5%. Let's say you're getting 5% interest. They're paying you 5% um as, a thank you for having the money in the bank. You will end up making $139,000 because of that simple interest. So that 5%, which maybe doesn't seem like a lot, over time, obviously, you do that year and year and year, that starts to accumulate over time. So that would be simple interest. It's just that extra 5%. Now, compound interest is when you make interest on your interest, which is very confusing. But the idea is, let's say you put the money in the bank, you get that 5% back every single year. And if you just keep that 5% that you made, that's your interest. If you just keep that in the account, then now you have more money, right? And then you're getting 5% interest on top of all of that. And you take that 5% and you leave it, and let's say you leave it in the account and you just keep letting it grow, then you get 5% on all of that back. And it grows and it grows and it grows. So the initial interest, the idea of simple interest is just that 5% every year. The compound is when you keep that interest in there and now you're accumulating on top of that. Is that making sense? This is such a confusing concept to explain. So again, they're giving you 5% on your money. If you just keep all of that you earn and you keep making interest on top of it and you never take that 5% out, that's where you get this compound interest number. So what's interesting about what this chart is showing us is one, compound interest is really powerful because we're accumulating money in multiple ways. The other thing that this chart shows us is how big of a or how big of an impact time really does have when we think about investing. So investing and particularly interest might not feel that glamorous all of the time, right? It might feel like a ton of money, but when you do a little bit over a long amount of time, especially with the compound interest, it starts to make a really big difference. Okay, I'm seeing questions. Just a second. Let's see. Oh wait, I swear I thought I had a question. Um, was there? Oh yes. Okay, I found it. Okay, so banks pay us to save money in the bank. It is going to depend on what kind of an account you have. So there's a lot of bank accounts that you're going to get a very like a fraction of a percent. It's not going to be very much. If you specifically look for like a high yield, they're called high yield savings accounts. Those are going to be accounts that are going to give you a little bit more. So again, the high yield savings account that I'm familiar with, I think I get 3.3%. So a traditional bank, you might get like point point something. It's going to be a really small amount. Something like a high yield savings account is going to give you a couple of percentages. And so again, when you think about that over time, you have a lot of opportunity there to make some interest and to specifically make compound interest over time. Does that make sense? Okay. Yeah, Jenna says.
Yeah, so is there a cost to having like different savings accounts?
So most of those savings accounts are not going to have a cost. Sometimes there will be banks that you have to pay fees. Um, there will be things like overdraft fees or things like that that you want to be mindful of, obviously. But a lot of banks, you're not paying anything to set up the account. They're making money off of you because your money is sitting in their bank. So they just want you to make an account. So again, the high yield savings account that I was referring to, it doesn't cost any money to set that up. You can set it up for free. You can put money in, and then you will make interest over time just by letting it sit in there. Does that make sense?
Yeah, okay, thank you.
What other questions do we have on this? Does anyone want to actually? Okay, we have a nice compound interest calculator here. Does anybody want to run an example and see how much money they can make looking at compound interest? Or do we feel like we have a good grasp? Let's do one example. If we want to go ahead and click that link and open up the compound interest calculator, we'll show you how to use it. It's pretty self-explanatory, but then you guys will know if you want to go play with this yourselves, how to think about it. So there's a couple of different steps. First, we want to think about, okay, if you look at step one, what is our initial investment? So let's just say we have $500 as our initial investment. We're just going to do a total hypothetical. And how much, someone put it in the chat, how much do we want to put in as the monthly contribution? How much money a month do you guys want to see us put into this hypothetical account? 50 bucks. Okay, we'll do 50 and then we'll do 200. We'll see what the difference is. Okay, we'll start with 50. Let's say we do this until let's say we do this for 30 years. Okay, that's again random. Um, Estimated interest rate. The graph from the other chart showed 5%. Let's do 3.3% because I'm pretty positive that's what my high yield savings account actually is. We can just leave the variance blank right now. I'm not too worried about that. Those percentages that the bank pay you will change over time depending on kind of what's going on with macroeconomics, but it's never really going to change that much. And then, yeah, let's say that we get to compound annually. So, and most of the time they will be annual. So when you see, um, uh, you'll see percentages as APRs, APYs, AR. Now it's all getting mixed up in my head, but basically it's per year. So annual. So if we calculate that, that work? Okay, it's calculating. The results are in. Okay, so this is great. So what you'll see in this graph is honestly, for the first like 10 years, it's not really going to feel like your interest. It's going to be pretty similar, right? We have the teal line at the bottom is showing us that's the amount that you are physically putting into the account every single month. So without any interest ever, if we go to year 30, would you mind hovering over at the end? The mouse, it should tell us what number that is. No, no, no. Scroll up. Just hover over. No, no, no. Just hover over the line. No, go back down. Yeah, there we go. Just if you want to hover over the blue line at the bottom, Yeah. Okay. So over how many years do we? 30 years. If you started with $500 and what did we put in? $50 a month. You end up putting in of your own money $18,500. By the end of the 30 years, you will actually have $31,298 in that account because the future value is that compound interest over time. So you're getting that 3.3% every single year. And when you keep that new money in, it grows over time. But you can see how, like at the beginning, it doesn't feel like it's that much money. Like the what you're making in interest doesn't seem like it makes that big of a difference. And then you kind of hit this inflection point and the lines will get further and further apart, and you'll really start to feel the effects of that compound interest over time. So, again, it doesn't feel glamorous in the beginning, but time is absolutely on your side. That is the best news about investing is if you've got time on your side, it can make a big difference, especially if we get into habits of doing little bitty contributions consistently for a long time. It's really going to pay off. Do we want to do one where we put in $200 a month? Let's scroll up to the top and we don't have to change anything, just change it from 50 to 200. I'm curious where this gets us. Okay, where do we end? We end with $121,219 if we put $200 a month in. We've put in $72,000 of our own money. So again, I mean, I'm not a math person. I was a journalism major, so give me a little bit of grace. But, that's 40 plus $1,000 of money that you were just making in compound interest. Does that make sense for you guys? So you can play around with this. Again, 3.3%, that's going to be one of your safer routes in terms of investment options, something like a high yield savings account. It's a lower return than other options that we're going to talk about, but it's really safe. So that's one of the things to think about. And even going that safer route, if you're able to do it for a long time, you start to see where that pays off. What questions do we have about compound interest or how to use the calculator? Does that make sense? We can go back to the slide then. I think we have a workbook question next. So we will give you guys a minute or two, and I want you to think about why do you think saving or investing earlier in life can make a bigger difference than starting later, even if the monthly amount is small? How might this change the way that you think about money now? So spend a couple minutes, go ahead and digest that. Oh, yes, let me go over really quickly again sorry, I just got a question the difference between simple and compound interest. So simple interest is just like I was using the 3.3% example. The amount of money that you make in a year, that like percentage, that's the simple interest. When you let that interest stay in the bank, now we have more money, and now you're going to make interest on a bigger pot of money. So when you keep the interest that you made in the account and then you get to make interest on that, that's the compound interest. So the idea is the bank pays you interest, you just leave it in there, and that will compound over time. And you'll make money not only on the money that you're physically putting into the bank, but you'll also make money on the interest that the bank is giving you. So that's where you get the compounding effect. Does that make sense? Cool. Okay. So, go ahead, digest that for a little bit. We'll give you 90 seconds to answer this question in your workbook. Okay. Do we feel good about how time plays a role in all this? So the question we had around the long run, if we do a little bit consistently over time, it can really pay off. And again, that first example, we're doing $50 a month. So it does not need to be crazy to have a big impact over time. Okay, let's keep moving and get into some more topics. Okay, so these are a lot of a lot of options and some just basic vocabulary that I want to make sure that we're all on the same page about. So, first we have kind of the idea of saving versus investing. Now, that example that I was talking about earlier on a high yield savings account, again, that would be the savings route. When we put money in a savings account, it's pretty safe. It is super accessible, so we can get to the money really easily. We can if you ever hear someone talking about money being liquid, the idea of, oh, I have liquid money is it's easily accessible. If I have money in a savings account, I can go to an ATM, I can take the money out, I physically can have it very quickly. You can move it around in a day, you can go to an ATM, get it instantly. So it's just more like we can access it more easily. Um, you do get lower returns. So again, that 3.3%, it's not a huge, crazy high percentage, but even like the upside is it's a lot safer and it's really easy to access. So again, I'm talking about high yield savings account. If you ever heard of something like a CD, that's another example of a type of account that we can put our money in that, again, is lower risk, but uh, it's lower risk and lower rewards. It's a little bit safer. So again, going back to kind of what I said at the beginning, depending on what is important to us, going more of a low risk route is going to make a lot of sense. And for everybody, having some amount of money in savings that is accessible is really important. We want to make sure that we have like an emergency fund, for instance. Like that is the kind of thing that we always want to make our priority number one. We don't want to go into investing until we feel like we have an amount saved that is going to help us if, again, as the name would suggest, an emergency happens. Everyone's going to have a little bit different number and barometer for that. Um, but typically what people say is what's 3 to 6 months of living cost? If you can have that, if you can try to save up that amount of money in a savings account, that's a really good amount of money to be able to have access to. That way, in case something happens, you have that to lean on and it's really easily accessible. So saving again, like low returns, but lower risk and really good to have money in savings. Then our next option is investing. So investing can happen in a lot of different ways. We're going to go over different options for investing. But the idea is I'm going to put my money into certain assets. And the whole point of me doing that is I am looking for more returns. So I'm either looking for, if it's a stock, I'm looking for that stock price to go up. If I get dividends on a stock, so certain stocks, if you invest in them, you'll get dividends, which means at the end of every year, if the company is profitable, they will pay money out to the people who've invested in them. I'm looking for interest. Like we're making specific investments. I'm putting my money in specific places because I'm looking for more of a return. So you can get higher returns over time, but it's also more risky. So your value, it can go up and down. You can definitely lose money when you think about investing. So higher risk, but also higher reward. I think on average, if you put your money into the S&P 500, which again, the S&P 500 is like the top 500 biggest companies in the United States that are on the stock exchange that we can easily invest in, like you're looking at an average like return of closer to 7 to 10%. So that gives you a sense of you're getting much more return than that savings account, but it's also risky because just because on average it goes up and it's which makes it, pretty solid long term, at any given moment it could go down and it could drop. And if you're dependent on that money in that moment, you can lose a lot of money if you need access to that. So definitely higher risk, but also higher reward. So investing can make sense if we feel like we've covered our bases from a savings perspective and we feel really good and we now have extra money, um, that we feel like we can be a little bit more flexible and we're not as dependent on it. Investing can be a good strategy if you feel like I'm not going to need this money anytime soon. And so if I know that I can put this money into an investment and I know that it can be long term and I'm not going to need it in any specific moment, then that's money that is safer to invest because even if the price goes up and down on a day-to-day or even a year-to-year basis, it's not going to affect me. It's not going to affect me because I'm not relying on actually needing to use that money. Um, so that usually, again, general principles, you're investing money that you're not expecting to need to use in the short term. Does that make sense? What questions do we have on saving versus investing? I know that somebody asked, how do I know how much money to invest? Does that kind of answer that question, or should we go a little bit deeper on that? Again, it's going to be different person to person, but part of it is figuring out what money do I potentially need in an emergency, or is there anything else in the short term that I'm looking to save for? If anything short term that you're expecting to need it, let's put that in the savings account. You guys worked on budgeting last semester. So again, when you have all these bills to pay, have a pretty good sense of like, this is how much money I need to live every month. And we want to make sure that we have enough months covered that in case something happens, you lose your job, something goes down, that you have that money that you can rely on because you've planned for it. It doesn't have to be stressful or as stressful. Okay. So a couple of other things to cover. Inflation and then real returns. So inflation is just um, how much more expensive things become over time. So as inflation goes up, the price to purchase the same thing goes up. So if a year, I feel like eggs is like the example that everyone talks about, right? It's like a year ago, if eggs, I don't buy eggs, so I don't know what eggs cost. I shouldn't have used this example. But let's say eggs cost $4 a carton. I literally have no idea if I'm even close there, but I should have done something that I know what it costs. Let's say eggs cost $4 a year ago. Now they cost $5. Okay. That would be an example of the exact same product 1 year later, the cost of that goes up. And so you'll see numbers of inflation. Oh, this is basically when you see inflation numbers, it's looking at, generally speaking, how much more expensive is everything now than it was a year ago. Now, inflation is normal. Over time, things get more expensive. That's a very normal thing, and so there's a certain amount of inflation that we just expect. Um, and then sometimes inflation can get even higher than normal, and then people that obviously starts to have a real impact on what we are actually able to buy if, the amount of money that we're making maybe is not keeping up with how much inflation is going up. What this has to do with the idea of real returns. So we always want to we you want to keep inflation in account when you're thinking about how much money I'm making. So if inflation is 3%, so just naturally over the course of a year, everything goes up 3%, and I've got my money in that savings account and I'm getting 3% back, then at the end of the day, I kind of, in terms of real returns, would be even because the money that I have now is still able to buy the exact same amount of things as the money that I had a year ago. So I've kind of broken even. Let's say I was making 5% on that money and inflation was 3%. I have 2% in real returns. So in terms of how far my money actually goes, I've made 2% more because inflation has gone up, but I've made a little bit more than inflation. If inflation went up 15% and I was making 5% on my money, my real returns would actually be negative. I might technically have more money in my account at the end of the year, but that money doesn't buy as much because inflation was so high. So that's the idea of real returns. We want to keep inflation in mind when we're looking at how much money we're making. It's not just the amount that we have, but how much will that actually buy us at the end of the day? Does that make sense? Sorry, I just saw this question. Okay. Oh, it's already, wow, there's so much that we need to cover. Okay. So fees, taxes, and costs. Sometimes we do need to pay fees, we do need to pay taxes, we do need to pay costs on things. Again, I'm not going to go too far into taxes because this is taking a lot of time, and we're going to cover taxes next week. But sometimes we have to pay um, fees and extra costs on different items. One thing to keep in mind when it comes to investing is, again, there's no guarantees. So we can make these investments, but again, they are much higher risk. Like we talked about, there's no guarantee that you're actually going to make money. We can say that on average, in the long term, people make money, but that does not mean that you will always be making money. The price of a stock, for instance, could go down. And then we covered when to save versus when to invest. So I feel pretty good about that. Anyone have questions on those? Okay. Let's go ahead and jump to the next workbook question and do 60 seconds.
I think Lizzie has a question.
Oh,
Sorry.
sorry. Yes, go ahead. Yep. Oh, you're on mute.
Um, I understand that you invested in a bank, right? You invested in
I
a bank?
have money in a savings account.
Right. Okay, in a
Yeah.
savings account. Have you invested in other companies?
I do also have money that is in the stock market. So that
Mm-hmm.
would be extra. So the stuff that I have in my savings account is money that I know I want to have access to short term. And then stuff that I've invested is any money that I think, you know what, I don't need access to this short term. I'm okay with investing in the long term. And if things are volatile, it
Right.
won't actually affect me because I'm not planning to use that money anytime soon. Does that
Which would you say that which one would you prefer to invest more in? Like,
It depends on what your goals are.
mm-hmm.
So, for instance, right now, I would love to buy a house one day. If I want to buy a house in the short term, that's a example of I might need my money at I'm hoping to spend that money sooner rather than later. So it's actually an example of keeping my money in savings where I can access it and it's a little bit less risky, makes more sense because I'm saving up to use my money in the short term. If I was like, I have nothing that I want to spend my money on, I have my emergency fund and I feel good, then that maybe I'm more in a place where it's like, oh, let's put money into a longer term investment and let it grow over time. So a lot of it will have to do with what are your goals at any given moment, if that makes sense. Okay, let's jump to the workbook question. And let's do 1 minute here. And just think about what's a short term, what's a long term goal that you have? Do you feel like savings makes more sense, or do you feel like investing makes more sense? Yeah. Okay. Can we go ahead and start that? Okay, let's quickly go to this next slide. I'm gonna move as fast as I can. We're gonna talk about all these different options for what investments can look like. So again, the idea of we don't want to put all of our eggs in one basket. Here's some options. First thing that we have is stocks and equities. So if you ever hear someone saying, I'm investing, if you're investing in a company, you're investing in a stock, that's what they're talking about. Certain companies are public, certain companies are private. Private companies don't have stocks that you can access easily, but public companies, which are basically the bigger companies for the most part, if they are public, you can buy a stock. You can buy a percentage of that company. And you just create an investment account and you can go on and you can pick out which companies you'd like to invest in and you can buy portions of a stock. Um, invest as much money as you would like. Um, Generally, buying individual companies is considered one of the highest risk things that you can do. Yes, a company could grow and you can make a lot of money. Those companies could also disappear and then you could lose all your money. So investing in one single company at a time is really high risk, but basically how you decide what kind of a company to invest in or if you don't want to do that, is public companies are required to put out information around how they're performing. And so you can look at performance, you can look at their financial information and research the company and decide, oh, I think this company is on a good trajectory, so I would want to invest in them. Again, investing in one company at a time is the most high risk. What is more common is what we call mutual funds or ETFs. So that is basically somebody has already put a bunch of companies together in a giant pot and you're buying a little sliver of all of them. And so that is what a mutual fund is. It's saying when you reference the S&P 500, that's an example of a mutual fund. If I bought shares in the S&P 500, it means I'm buying a teeny tiny percentage of all 500 companies. That tends to be less risky because if one company does poorly, then I'm only a tiny amount of what I've invested is actually only happening, you know, is only impacting the number a little bit. So mutual funds and ETFs, there's lots of different kinds. Again, the S&P 500 is the most common, but there's lots of kinds that are different bundles of different types of companies, and you can buy those, and that's going to already be a little bit more diversified, and it's going to be less risky than investing in one company individually. Does that make sense? Then you have something called bonds. Those generally are, those are going to be less return, but they're going to be safer. So generally, so you can buy bonds in a company, for instance, but you're not going to make the same amount of money, but also it's going to be, again, like I said, safer money. So if you're looking for a safer investment option, bonds can be a good choice. Um, Other things to take into consideration, which I won't go into too much detail on here. Real estate. So if you're purchasing real estate of any kind, that's an investment. That's a way that your money can give back to you. Um, there are also retirement investment accounts and that you can put money into or you can save money on taxes if you put money in them and you wait to use that money until you're retired. So depending on, again, how long term you want to save that money for, looking for retirement accounts can be really helpful. And then again, just the idea of diversifying, getting shares or stocks from different size companies, different types of companies, that can also help to kind of diversify where our money is going. The idea is we don't want to put all of our money in any one option. We'd love to have it spread over some different options. That way, it just tends to be a little bit safer and a little bit less risky. That way, if something does, something is a little bit low, something else might be a little bit high, and it kind of evens it out over time. Does that make sense? Okay. I know we still have some workbook questions that we may or may not get to today. Let's go ahead and go to the next workbook question. We'll do 90 seconds on that, and then I'll wrap up with announcements here at the end. So why is diversification often safer than putting all of your money into one stock? Go ahead and work on that. Beautiful. Okay. With that, we can move on to the next slide, which I think gets us into next week. So, yeah, like I mentioned, I know I didn't touch too much on taxes today, but that is going to be the whole topic for next week. So, what are taxes actually? Where does that money go? What does it go towards? We'll talk about the different types of taxes and how they're collected. So, obviously, you pay taxes when you make money. You also pay taxes when you buy things at the store. So, we'll talk about all of those different things, and particularly around your paychecks and all of that good stuff because we're in tax season, so it's very, I feel like it's very relevant. Let's go ahead and I want to make sure, I would love to do announcements actually just to make sure that we get them in. So, again, some of this we covered last time. The field trip to the Junior Achievement Finance Park is happening. You can either choose February 7th or February 14th. The deadline to pick those is in 2 days, so on Friday. We want to get RSVP for that. The Ignite Speaker Series is happening on February 2nd. Again, remember that if you ever miss a class, being able to attend that speaker series is a way to make up those points. That is a virtual event. Again, that's happening on February 2nd, and the RSVP deadline is also this Friday on the 30th. If anybody is interested in becoming a student leader who is not already a student leader, especially if you're trying to speak up more or you want to lean in and have more responsibility in these classes, you can fill out the form. The form is due on February 12th, and then the training to be a student leader is going to happen on February 13th. So you have a little bit of time to think about it. Let us know if you have any questions around what being a student leader entails. Another one that we covered last time, if you are in a college match program, go ahead and we have a form that we'd love for you to fill out just to track if you're currently involved. If you're not involved in a college match program, don't worry about it. But it's helpful for us to know what's going on that front. Lastly, there is a free Mustang immersive experience. Um, you guys have some free tickets available for this. So I think you can get up to 4 free tickets, I believe. You have to do a little bit of, you have to buy every ticket separately and you have different promo codes for them. But you can get a free ticket to go to this Mustang immersive experience. Um, and so if that's something you guys are interested in, I think you just have to fill out a form and then we'll send those tickets to you. And then for alumni specifically, there is a First Gen Career Institute um, or Career Institute Spring 2026 is open. So it's a program for anyone. It's a program designed to support first gen college students as you are looking at career and professional skill building. So if you're an alumni and that is of interest to you, that is also open now. I know we're now at time, so I'm going to let you go. But if anybody has any outstanding questions, feel free to hang around and we'll get those answered.
All right. Thank you so much,
Everyone.
Haley. Thank you,
Or
everyone. Please send us an emoji before you go, and we really do hope we see you on the field trip. Bye.
thanks, everyone.
Bye, Dubs. Bye, Mia. Bye, Natalie. Bye. Bye, Alexander. Bye, Diana.
Guys.
Bye, Idanya. Bye.